Hi, everybody, and welcome to the Buffett and Beyond Stock Analysis Video Podcast with your host, Dr. Joseph Belmonte, which is me, and Debbie with a Y. Hi, Debbie.
Hey, hello.
And all these methodologies are based on the book Buffett and Beyond, second edition by Dr. Joseph Belmonte and published by Wiley Publishing. And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. Now remember, folks, the clean surplus return on equity is both a comparable and a predictability model and is totally different than the traditional accounting return on equity. So don't get them mixed up. And you can equate the clean surplus return on equity as the interest rate you get from a bank. So this is common sense now. A bank account with a higher return or interest rate will earn you more money than an account earning a lower interest rate. So it just follows that portfolios made up of stocks with high clean surplus ROEs or return on equity will outperform other portfolios made up of stocks with lower return on equity or interest rate. So think of your bank account when we talk about these stocks. The good.
Stocks that should be in our portfolio.
The bad.
Stocks that should be in somebody else's portfolio.
And the ugly.
Oh, stocks that should be in nobody's portfolio.
Okay, let's get on with some stocks. You'll see exactly how this method works and how we here at Buffett and Beyond set the investing parameters so that you, all of you, can outperform most of the professional money managers out there in investment land. Well, hi, everyone, and welcome to Buffett and Beyond Research and the Stock of the Week. And remember, folks, if you want to live on this beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. And this week we're going over a stock in the internet, and you all know it, folks. It's called Alphabet, and we all know it as Google, or Goog by some. And they're the same stock, G-O-O-G or G-O-O-G-L, except one has more voting rights than the other. All right, let's get right into it. As if you didn't know what this stock does, it's the successor and parent holding company of Google, which operates the world's leading internet search engine. And the company derives revenues primarily through delivering targeted advertising. In other words, folks, when you're on the internet and you do any kind of search, these search engines know all about you. Now, revenues are also derived from the licensing of search technology and solutions. And revenues in the United States, 48%, and from international, 52%. Has 190,000 employees, and folks, that's about 25% more than it did several years ago, because we have those numbers. Now, here's what's important. It owns YouTube. Folks, YouTube has a couple of billion people that play with it, and also increased income from Google Search and Google Cloud. So, the company is all over the place. All right, let's look at some easy charts here, and the blue lines are the average stock out there. Now, remember, the average stock, when we talk about averages, we talk mostly about the S&P 500 index. And folks, a Morningstar report said that from 2002 said that 96% of professional money managers who manage the publicly traded mutual funds cannot outperform the S&P 500 index over any 10-year period. Again, 96% of professional money managers cannot outperform the S&P 500 index over any 10-year period, 10-year rolling period. So we use the averages, and we try to fill our portfolio with stocks that are better than average, so we can outperform not only the S&P 500, but also those 96% of professional money managers out there. Blue lines represent the average stock in our database, which is about 1,800 stocks. So it's almost 4 times more than the S&P 500. So blue lines represent the average stock. The green lines represent Google. So when we look at the return on equity, and clean surplus return on equity is different than the traditional accounting ROE by a long shot. And that's exactly what we are experts on. But think of your bank account. Make it simple. Bank account, average stock is returning, giving you a 13.5% interest rate per year, or I should say return per year. And Google is giving you 21.5%. So right there,
All the original research is on this number alone. If you outperform or build a portfolio of stocks that outperform the average stock, you're going to outperform the averages. Now, net income, which is a bottom line income, and it's different than the traditional accounting earnings. So net income is the clean surplus earnings, almost double the average stock out there in investment land. When it comes to revenue, how much money does this company bring in? And these are 5-year averages. Average stock 7.1%. Google is more than twice that at 17.2%. So when you look at this chart, blue lines the average, the blue vertical lines are the average stock. The green is Google. So Google's outperforming on 5-year averages over the average stock out there, and that's what we're looking at. Now, let's just look at something I want to show you here. Back in 2020, the net income for Google was $2.93. Now, for 2024, they're expecting almost double that. In fact, it is double that. So they're expecting almost $6 per share of net income. And this is going to come in someplace very, very important in a few charts. But let's look at the clean surplus return on equity. Here's 2021. And of course, everybody was inside in 2021, weren't they? As COVID was still in effect and everybody was still inside. So it made a serious return on equity. But before that, it had been around 19%, 20%, 21%, 18.5%. And for this year, 2023, it's about 18.1%, and the same for projected for next year. Now, what it's doing, retention rate is 100%. That means this company is taking all the money it's making, putting it back into itself in order to grow. And when you look at the clean surplus return on equity, better than the average stock, we know they are investing the money they are making back into itself and returning a better rate of return than you can get by investing in the S&P 500, which in turn outperforms 96% of professional money managers. So let's look at the net income growth. 5-year average, 23%, as we showed in the last chart. And you can see they're coming back strong from 2023, 10.7, expected to go up significantly for 2024. The problem is that revenue growth is low for next year. So that's the one thing that's affecting Google at this present time, because its average has been around 17%. And this year and next year, it's not doing as well, but it's doing better than the average stock, and that's all that counts when it comes to building a superior performing portfolio. Now, let's see what it's done year to date. Black line is the S&P 500 down here at a little over 15%. Google is up about 35%, more than double the average stock out there. And Google, of course, is this yellow or mustard colored line, doing very, very well year to date. Now, over the past 5 years, again, black line S&P 500 up a little over 60%. Google is up close to 120%. So it's almost doubling the average stock out there. So yeah, it's a pretty good portfolio, or a pretty good stock to have in your portfolio. Now, I want to show you something. Remember back in 2020, we were looking at the stock was making, now this Google is the black line here. The stock was making $2.93, almost $3. So this is what I want you to look at. This is 2023, 2022, 2021, and this is 2020. So in 2020, this stock was making, let's see, $75 is this line right here, $90 is this line here. What I want to show you is that next year they are projecting this stock to be making twice as much as it per share as it did this year, which is 2020. So it should be double in price if other things are being normal. Now, don't remember, 2020 was a year before this dramatic rise in 2021 came along and the market became overbought. So if we're looking at anything between 75 to 90, and in 2024, next year, this stock Google is supposed to make twice as much as it did back then. This price of this company should be about double. And if you take the low end in here, the $75, it should be around $150. If you take the $90, it should be $180. So we're looking at this stock to be somewhere between $150 to $180 by the end of 2024. So we expect a substantial rise in this stock between now and the end of, or even the middle of 2024. So in about a year and a half from now, we expect a very, very nice rise in this stock. And that's how we look at these companies. We look at what did they make in the past, where were they trading in the past, and what do we expect them to make next year, or even the end of this year, but it really into 2024 now that we have those numbers. So the key is to put better than average stocks in your portfolio, and let's see how our portfolios have done over the past 20 years or so.
Well, JB, I think we've just about covered all the questions sent in by our listeners out there in investment land. And remember, folks, we're here to answer your questions not only about individual stocks, but also about the stock market in general. So keep those questions coming, and who knows, we may even answer a question or two you didn't even know you had. And that's about it for today, JB.
Okay, folks, we had a great day today.
And tomorrow will be even better.
All right, bye, folks. We'll see you next time.
Bye, everyone.
And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. We've had a good week, folks, and here's hoping that next week will be even better. You have a safe weekend, and we will see you next time.